Good Wednesday morning, everyone. Thank you so much for joining us this morning. Coming to you live from Washington. It is Wednesday, November 19th. We are coming to you from our nation's capital this morning, and it is 8 a.m. on the button on the East Coast. The Trump administration is weighing IPOs for mortgage giants Fannie Mae and Freddie Mac, possibly as soon as the first quarter, I'm told. But billionaire investor Bill Ackman has a different plan, and he laid it out in a new roadmap on X yesterday. Ackman says now is not the right time for the Treasury to sell their stakes in both firms. Instead, he wants Treasury to cancel the government's senior preferred shares, exercise warrants to buy up to 79.9% of the common stock, and relist both companies on the New York Stock Exchange. Ackman says that approach could generate about $300 billion for taxpayers without rushing into a new IPO. Joining me now is Pershing Square Capital Management founder and CEO, the man himself, Bill Ackman. Bill, great to see you. Thank you so much for joining us.
Of course. Thank you.
And I want to start off with your plans for Fannie Mae and Freddie Mac. Tell us how to see the most possible growth of these giants in mortgages right now.
Sure. If you look back, the president explained that he had the opportunity to sell these companies for $100 billion during his first administration, and he very intelligently chose not to. He didn't want to leave a lot of money on the table. But he didn't get to finish his goal of privatizing both companies. Now he has that opportunity in his second administration. But our view is rushing to an IPO is a mistake. We think these entities are going to be worth a lot more over time. And the administration has a few objectives. They want to show taxpayers how much value has been created. They want to mark to market, as Howard Lutnick has referred to it. But they want to do that in a way that minimizes, actually really eliminates risk that mortgage spreads would widen. In our view, basically, if you try to get an IPO done now, I think there's risk. There's a lot of work that needs to be done before these companies can be regular way public companies out of conservatorship. Our view is you can't take them public when the government, has them in the sort of suspended animation of conservatorship. But you can take some important steps. Number one, the most significant overhang on Fannie and Freddie, which the president referred to in a letter in November of 2021, is the fact that the Obama administration came in just after these entities became profitable again and expropriated 100% of their profits, something called the net worth sweep. And Trump has called that theft. I think it's an accurate description. Secretary Mnuchin in the first administration stopped the theft, which is what enabled these entities to rebuild very significant amount of capital over the last number of years, 10 years or so. Now they're getting closer to a moment when they could be regular way public companies, but there are a lot of steps that need to be taken. The capital levels need to be reset. We need to have the right management teams in place, the right boards of directors. We have to have, these companies lost a lot of money for shareholders, so before you do the biggest IPO of all time, you want shareholders to be excited about what's going on. We think an IPO would be unsuccessful. So our view is, simple step. Recognize the theft, reverse the theft, if you will, by accounting for all the payments that have been made to the government. The government lent $191 billion. The entities, the Fannie and Freddie, paid back $301 billion. That's actually, it was supposed to be a 10% return. The government got almost a 12% return. Let the government keep the extra $25 billion. They exercise their warrants, and then they uplist on the New York Stock Exchange. The New York Stock Exchange, of course, would be delighted to have these entities trade there. Then you start building an institutional base of demand for the companies. We think the stocks will trade, as much as into the 40s per share, which would be an enormous value creation. They would have something approaching a $400 billion market cap, and they would continue to grow in value over time, and that gives the administration time to work through the capital rules, make sure that there's no threat to the mortgage market. So I totally agree with the president's ambitions here. This achieves his objectives in a kind of slow and steady approach, which I think is very consistent with, what the Treasury Secretary would like to see as well.
I mean, there's also, not exactly clarity when you take a look at each company. I mean, they're not the same, right? I mean, recently we saw these stocks sell off because there was worry in the market that Freddie Mac is not as strong as Fannie Mae. So the two companies assess their profitability potential and their strength, because they're not the same.
They're not. They're actually quite similar. Actually, Freddie grew its guarantee book much more quickly than Fannie over the last number of years. The result is that Freddie is further away from the capital that's required for them to meet sort of a fortress level balance sheet. Freddie, in our view, is almost there today. But there's actually, if you think about it, in a world of AI, These are businesses that could be massively optimized in terms of made more efficient, more profitable, better at underwriting, and ultimately delivering a value to the shareholders and ultimately to the mortgage borrowers that's much more effective. Let's give them the time to do that while the government retains its 79.9% stake in both companies. Then we can have a huge, there's no real rush. The government doesn't need the cash from Fannie and Freddie. What Secretary Lutnick talked about was, I think Jan Fox, or maybe it was CNBC, but he talked about creating a mark-to-market. These entities are already public, so the notion, it's not really an initial public offering. Really what we need is they trade in the pink sheets. And many shareholders, many institutions can invest in a company in the pink sheets. We're saying, look, list them on the New York Stock Exchange. That creates transparency, visibility. You build an institutional base of support for the companies. Analysts start covering Fannie and Freddie. They start to be in a position to become index eligible. But we do it in a very safe way. They're still in conservatorship. The government owns 79.9% of both companies. The government's still completely in control. That gives us the time, that gives the Treasury Secretary, that gives the FHFA, Director Pulte, time to kind of finalize what the right capital levels are. We want these entities to have fortress-level balance sheets, but you don't want them to be massively over-capitalized because they'll never be able to earn an adequate return on an overstated capital level. And that's where the rules are now. That needs to be reassessed. It can't happen in 90 days. It can't happen by Q1.
And these are enormous. These are enormous companies, and you also don't want this to disrupt the overall mortgage market, right? At this very fragile moment in time, I spoke with Secretary Bessent about this just recently. Here's what Scott Bessent told me. Watch. We're talking about a $30 billion deal. Do you want to keep some stake there in Fannie and Freddie?
That's what the banks have advised so far. A $30 billion deal would be one of the biggest deals, maybe the biggest deal in history. And these are very large companies, valuations in the hundreds of billions of dollars. So if we were to sell a 3 to 6% stake, it would work out to at least that. Well, every bank's going to be, all the big banks are going to be part of something that's this size, and we're honing in on that. The president's been busy doing peace deals, trade deals, tax deals, and he can multitask better than anyone I've ever seen.
Your reaction, Bill?
Yeah, look, I have enormous respect for Secretary Bessent. He's done an amazing job. I can't point to anything that he's done that's not been executed really very well. So I think he's a star. And I also know that he's a very measured Treasury Secretary, and you want a Treasury Secretary that's not in a rush. So, if you look at what the president did in the first administration, he took a very important step in stopping this net worth sweep. Well, I'm suggesting just take another step. What's interesting is the step I'm advising can happen before the end of the year. Right, the accounting for the repayment of the preferred, the exercise of the warrants, and even the listing on the New York Stock Exchange, the president could ring the bell before the end of the year. It would be a major victory for the president. He could announce, he could show the taxpayer hundreds of billions of dollars of value that shareholders own. And those shareholders are 80% U.S. government. I'll also point out that there are millions of small investors that have owned this stock and have been decimated. This was a every American type blue chip stock before the financial crisis. There are a lot of long-suffering shareholders that have owned it. And then there's some institutions that have piled in more recently. Capital Group has bought a major position in the pink sheets. They're one of the few institutions that have been able to invest in the companies in the pink sheets. So let's build a base of institutional support, but there's no rush. The government doesn't need cash. Right? What the president's trying to achieve here is to show the taxpayer how much value that's been created. This is an asset that's going to grow in value very significantly over the next decade. I'd rather this become a sovereign wealth fund asset where we show it on the balance sheet of the U.S. government. It's going to grow more quickly. We're going to earn a higher return on Fannie Freddie stock than the cost of the 10-year Treasury, right? So one way to delever you don't need the cash to pay back U.S. government debt. What you'd like to do is offset our liabilities by growing some assets. And Scott has actually talked about a U.S. sovereign wealth fund. This would be a fantastic asset. Really, it could even be a permanent holding. You can envision this is a great asset for the country. Retain the 79.9% stake that the government got for bailing out these companies. Let the taxpayer benefit, as opposed to selling it before these institutions are at a minimum. Let's optimize them before we think about selling something that belongs to the taxpayer.
Well, there's also, policy changes that you'd like to see as a result of this. Like, for example, you want revised capital rules to allow the GSEs to earn adequate returns. What specific changes do you want to see in terms of capital rules, Bill?
Sure. So the capital rule was set at basically 4.5% of the outstanding guarantees, which is a level that is well in excess of what is necessary. The capital rule prior to the financial crisis was well below what was necessary. It was at 45 basis points. So the response to a crisis was, okay, we'll just raise the capital levels tenfold. The problem with that is that in order for these to be sustainable enterprises, they have to earn an adequate return on that capital. But that level of capital is so high that basically the government would have to raise the guarantee fee in order for the returns to be adequate. The problem with raising guarantee fees is every basis point of increase in a guarantee fee is an extra basis point of mortgage interest that the borrower is going to pay. So I think guarantee fees are already as high as they should be. At the current level of guarantee fees, at a capital level about 250 basis points, the entities would have the benefit of they could have survived multiples of the losses of the great financial crisis. So that I call that a fortress level balance sheet. But it's still a level of capital where they can earn an adequate return. And that's something that needs to be finalized. That's a process. Could it take 6 months? Could it take 9 months? Something in order of that. It can't happen overnight. You don't want to rush it. That's where risk to the mortgage market comes in. In fact, mortgage spreads are wider than they should be. I think part of that is all the uncertainty around Fannie and Freddie. I think taking a positive step forward, creating more transparency about these entities, listing them on an exchange where analysts can cover them, oversee them, investors can invest in them, I think would be an important step and will actually help lower mortgage spreads. So the interesting point is, by leaving them in conservatorship and listing them on the exchange, you get the best of both worlds. There's literally zero risk of mortgage spreads widening. There's the potential for them narrowing, and you get the benefit of the president's goal of showing how much value has been created. And he's going to look very smart because these entities were valued at, he could have sold them for $100 billion, 5 years ago, and now he's going to show entities that, we expect them to have something approaching a $400 billion value. As long as the administration sort of lays out, kind of the plan going forward.
Yeah, I mean,